Something just broke in the silver market that Wall Street told you couldn't happen. For months, technical analysts have been marking $75 per ounce as the line in the sand. The ceiling, the place where rallies go to die. Every time silver approached that level over the past several weeks, it got smacked down hard. Traders built entire positions around that resistance holding. Short sellers stacked their bets at that exact level, convinced it was mathematically impossible for silver to sustain a move above it. At the time of recording, that resistance just shattered. And what's happening right now in the derivatives market suggests this wasn't a normal breakout. This was a forced liquidation event that's still unfolding. Here's what makes this different from every other silver rally you've watched fizzle out. The breakout didn't happen on speculation. It didn't happen on retail FOMO. It happened during a liquidity crisis in the physical market while short interest was sitting near multi-year highs. The timing matters because it means the move higher isn't optional anymore. It's mechanical. When shorts are trapped above a key resistance level and physical supply is genuinely constrained, the mathematics of an unwinding position override every other market force. This is not about sentiment, this is about survival. Let's establish what $75 actually represented structurally. Since mid-November, every approach toward $75 meant coordinated selling. Open interest data from COMEX showed large commercial traders, the banks and institutions that typically profit from suppressing rallies, were heavily short in that zone. Position reports indicated they'd built up net short exposure assuming $75 would hold as it had multiple times before. That level wasn't arbitrary. It represented the point where industrial buyers historically pulled back, where momentum traders took profits, and where derivative positioning created a natural ceiling. Breaking through it doesn't just mean the price went higher. It means the structure that kept it contained for weeks just failed. Here's the mechanism playing out right now. A short position in silver futures is a bet that the price will fall. You borrow contracts, sell them at today's price, and plan to buy them back cheaper later. Your profit is the difference. But if the price rises instead of falls, you face a margin call. The exchange demands more cash to cover your potential losses. If you can't post that cash immediately, the exchange force liquidates your position, meaning they buy back your short contracts at market price to close you out. When multiple shorts face margin calls simultaneously and start buying to cover, it creates a feedback loop. Their buying pushes the price higher, which triggers more margin calls, which forces more buying. That's the death spiral. And the signature of a death spiral is unmistakable. Violent upward moves that pause briefly, then accelerate again as each new wave of forced covering hits. Pause for a second, because this is where the market structure gets really uncomfortable for anyone still short. The breakout above 75 didn't happen on massive volume like you'd expect from a genuine speculative rush. It happened on relatively controlled volume, which tells you something critical. The move wasn't driven by a flood of new buyers. It was driven by a shortage of sellers. When shorts try to cover but can't find enough liquidity to exit without pushing the price higher, that's not bullish momentum. That's a trap closing. And the trap doesn't reopen just because the price moves higher. It tightens. Now let's connect this to the physical market, because that's the real pressure point nobody's talking about. Over the past several months, industrial users of silver have been reporting extended delivery times for physical metal. Refineries have acknowledged production bottlenecks. ETF redemption requests have faced delays. None of this shows up in the COMEX price directly because COMEX trades paper contracts, not physical bars. But when someone holding a short contract realizes they might actually have to deliver physical silver if they are assigned, and they look around and see that physical silver is genuinely difficult to source, quickly their risk calculation changes instantly. Suddenly that short position isn't just a bet on price direction. It's an operational nightmare, and operational nightmares get closed fast, even at a loss. Here's what most people miss when they watch silver move like this. The industrial bid for silver is completely inelastic below certain price levels. A solar panel manufacturer doesn't care if silver is at $75 or $80. They need the metal to complete production runs that are already contracted and financed. They will pay whatever price is necessary to secure supply. That creates a floor under the market that rises every time physical tightness increases. And that floor just moved decisively higher in the last 48 hours. The companies that waited, hoping for a pullback to buy cheaper, just got priced out. Now they're competing with short covering buy orders and with each other for shrinking available supply. This is where the story flips. In 2011, silver ran to nearly $50 per ounce and then collapsed because the rally was built entirely on speculative momentum. Hedge funds and retail traders were using leverage to chase the move higher. When sentiment turned, there was no fundamental floor under the market. The longs liquidated, the price crashed, and it took over a decade to recover. That's not the setup this time. The current rally is built on a supply deficit that industrial users cannot ignore. When the price pulls back, they buy. When it consolidates, they buy. When it breaks out, they panic and buy faster. That's the difference between a speculative bubble and a structural repricing. So here's the uncomfortable question nobody on financial media is asking. If the shorts are underwater, if physical supply is genuinely tight, and if industrial buyers are willing to pay up, what exactly stops this from accelerating further? The usual answer would be that the exchange steps in and raises margin requirements to force liquidation of long positions. But we're past that point. The move above $75 already happened, despite whatever margin adjustments were in place. The exchange can raise margins again, but if physical buyers keep absorbing every dip and shorts keep getting squeezed, the only outcome is a wider spread between paper price and physical price. And if that spread gets wide enough, it destroys the credibility of the paper market entirely. Let me show you what happens next if this continues uncontrolled. Right now, there's maybe $10 to $15 between the COMEX futures price and the premium dealers are charging for physical coins and bars. That spread has been widening for months. If it hits $30 or $40, suddenly miners have no incentive to deliver metal to COMEX. Why would they sell at $75 on the exchange when they can sell at $110 in the physical market? The answer is they wouldn't. And if miners stop delivering to COMEX, registered inventory drains to zero within weeks. At that point, the paper market either explodes higher to match physical or it collapses into irrelevance. Either way, the current structure breaks. Before you dismiss this as unrealistic, understand that we have precedent. In March 2022, the nickel market on the London Metal Exchange faced exactly this scenario. A major short squeeze drove nickel prices up over 250% in 2 days. The exchange literally canceled trades, suspended the market, and restructured contracts to prevent a total meltdown. The people who were long nickel and should have made fortunes got their winning trades erased. The shorts who should have been wiped out were bailed out. The lesson there wasn't that markets are safe or fair. The lesson was that when the paper market detaches too violently from physical reality, the authorities will intervene to protect the incumbents, not the rules. And that intervention doesn't fix the underlying supply problem, it just delays the reckoning. Let's zoom in on what happened next in that nickel situation, because it's directly relevant. After the LME suspended trading and canceled trades, nickel didn't magically become more available. The supply deficit that caused the squeeze in the first place still existed. All the intervention did was reset the price artificially lower and give shorts time to exit slowly instead of being destroyed in a single day. But within months, nickel prices were climbing again because the fundamental problem never got solved. The same dynamic is setting up in silver right now. If authorities step in to suppress this move, they'll buy a few weeks of stability at most. Then the pressure rebuilds, and the next leg higher is even more violent because the short interest comes back even heavier, convinced that intervention will save them again. Here's where the timing becomes critical. We're heading into the end of the year when industrial buyers finalize contracts for the first quarter. If silver is trading above $75 now, and if there's any concern about availability, those buyers will lock in supply at whatever price they can get. That buying hits the market in early January and could easily push prices into the low 80s before the next wave of resistance emerges. But if the shorts haven't fully covered by then, if they're still holding positions hoping for a reversal, that next move higher doesn't just hurt them, it eliminates them. There's a price level, probably somewhere between $85 and $90, where the losses become so severe that institutions holding short positions face capital adequacy problems. At that point, it's not about profit anymore, it's about solvency. This is not drama, this is mechanics. A heavily shorted market that breaks key resistance during a physical supply squeeze doesn't revert cleanly, it reprices violently. And the repricing doesn't stop until either new supply comes online, which takes years, or demand destruction happens, which requires prices high enough to force industrial users to find substitutes. Neither of those outcomes is imminent, which means the current trajectory, absent extreme intervention, continues higher. Now let's address what Wall Street will tell you starting tomorrow. They'll say this move is overextended, they'll point to overbought technical indicators, they'll trot out analysts saying silver always crashes after breakouts. They'll publish research notes explaining why $75 is unsustainable and recommending shorts at current levels. All of that will sound very reasonable. And all of it will be designed to create liquidity for the institutions that need to exit their short positions without moving the market against themselves further. When a bank tells you to sell something they're short, they're not giving you advice. They're trying to manufacture a counterparty. Here's the signal that would make this entire thesis wrong. If COMEX registered inventories suddenly surge, if multiple refineries announce they're ramping production, if industrial buyers publicly state they're delaying purchases because they expect lower prices, then you'd have evidence that the supply tightness narrative is overblown. But as of now, none of those things are happening. In fact, the opposite is happening. Registered inventory has been trending lower for months. Refineries are operating near capacity. Industrial buyers are issuing statements about securing long-term supply agreements. That's not the language of a market about to correct. That's the language of a market preparing for scarcity. So what happens if I'm wrong? What if this is just another failed breakout and silver collapses back under $70 by next week? Then the shorts survive, the paper market maintains control, and the physical supply concerns get dismissed as exaggerated. Industrial buyers go back to waiting for cheaper entry points. The system continues functioning as it has for the past decade. But here's the catch. If that happens, it won't be because the fundamentals changed. It'll be because intervention forced a reset. And every time that happens, the next surge becomes more inevitable and more explosive. Because the underlying deficit doesn't go away. It compounds. This doesn't mean silver is headed straight to $100 without a pullback. Markets don't move in straight lines, and short-term volatility is guaranteed. What it means is that the control mechanisms Wall Street relied on to cap silver below 75 just failed. And once control breaks, getting it back is exponentially harder. The shorts who survived this breakout by covering quickly will be hesitant to re-enter. The shorts who didn't cover are now trapped at higher levels, and the industrial buyers who were waiting for a discount just learned that waiting has a cost. Let me show you the broader context that makes this moment different. Central banks have been accumulating gold at record rates for 3 years. They've collectively added over 3,000 tons to reserves since 2022. Why? Because they see what's coming. Currency debasement, loss of confidence in fiat systems, and the need for hard asset backing when the next crisis hits. But gold's market is enormous, and moving gold in size is difficult. Silver, by contrast, is a smaller market that moves faster and offers operational leverage for entities, trying to position before everyone else figures it out. If even a fraction of the capital chasing gold starts rotating into silver for tactical positioning, the dynamics we're seeing now would look small by comparison. The question is not whether silver will hit 100. The question is whether you understand what's happening clearly enough to see it while the market is still repricing, rather than waiting until the move is complete and then wondering why you missed it. The pattern is already visible. The shorts are trapped. The physical market is tight. Industrial demand is inelastic, and the resistance that was supposed to hold just shattered. That's not a prediction. That's a description of what's happening right now. This is where the analytical honesty matters. None of this guarantees silver goes straight up from here. Extreme intervention could force a reversal. A sudden economic slowdown could reduce industrial demand. Massive new supply could materialize faster than expected. Any of those outcomes would change the equation. But as of right now, at the time of recording, none of those things are in motion. The equation is still pointing in one direction, and that direction is higher. That doesn't make silver a safe investment or a guaranteed winner. It makes it a market in the middle of a structural repricing where the people positioned correctly are making significant money, and the people positioned incorrectly are facing significant pain. If you're holding physical silver purchased months ago, you're watching vindication play out. If you're short silver right now, you're watching your thesis disintegrate in real time. And if you're on the sidelines trying to decide whether to enter, you're watching a window that's closing faster than most people realize. If this pressure continues, where do you expect it to surface next, and why? Let me know in the comments. If you want to stay ahead of moves like this before they become obvious, subscribe now. We're tracking the markets that are restructuring in real time, not the stories everyone already knows.